Today, we will identify 20 companies within the S&P 500 index that are considered undervalued. Undervalued stocks are those that are trading at a price lower than their true worth, often presenting an opportunity for investors to purchase them at a discount. But, what makes a stock undervalued? Stocks can become undervalued for various reasons. Sometimes, an entire industry might be facing temporary challenges, causing good companies within that sector to be overlooked. Other times, a company might have strong underlying financial health and future growth potential that the broader market has not yet recognized. Key indicators of an undervalued stock often include a low price-to-earnings ratio, strong balance sheets, and healthy free cash flow. However, it is important to note that a low price does not always mean a stock is undervalued. There might be hidden issues, such as poor management or fundamental problems within the company, that justify its lower price. Therefore, thorough research is always essential before making any investment decisions. Let's check out the list of the 20 most undervalued stocks in the S&P 500 right now. 1. Comcast Corporation. Comcast is a large media and technology company. It provides cable television, internet, and phone services to millions of customers. It also owns NBC Universal, which includes television networks, movie studios, and theme parks. Despite its broad reach and consistent revenue streams, its 5.53 price-to-earnings ratio suggests that the market may not be fully appreciating its value. It also boasts a generous free cash flow yield of approximately 16%, suggesting solid cash generation relative to market price. Analysts argue Comcast is quietly undervalued despite being a major media and telecom powerhouse, spanning NBC Universal, Sky, theme parks, and more. Although the company has faced challenges like subscriber losses, investor attention is shifting to potential catalysts such as media spin-offs, theme park gains, and its robust content portfolio. Comcast is a unique blend of underrated value and dependable income. Its diversified media businesses and potential for strategic restructuring provide upside, while its low valuation and income stream offer a safety buffer. It's the type of stock that may appeal especially to value investors. 2. APA Corporation. APA Corporation is an independent energy company that explores for, develops, and produces oil and natural gas. The company has operations in the United States, Egypt, and the North Sea. Energy companies can often be cyclical, meaning their performance is tied to the ups and downs of commodity prices. APA is trading close to $21.64, which is about 25 to 30% below its 52-week high of roughly $30. Analysts estimate the intrinsic value of APA to be around $47, suggesting the stock could be undervalued by approximately 54%. Value-focused funds like the SMED Value Fund have increased their exposure to APA, seeing it as a broad second-best buying opportunity in energy in 20 years, thanks to its solid balance sheet and strong return on capital. APA has been simplifying operations, selling non-core assets to reduce debt while improving operational efficiency. 3. Centene Corporation. Centene Corporation is a healthcare enterprise that provides programs and services to government-sponsored healthcare programs, focusing on Medicaid, Medicare, and the health insurance marketplace. As a major player in government-backed healthcare, Centene has a stable customer base. Centene trades at a P/E ratio of approximately 7x, which is considerably lower than the healthcare industry average of around 21x. Compared to its own 5 and 10-year P/E averages, in the low 20s, today's level is 68% below historical norms, signaling potential deep undervaluation. Analysts see meaningful upside ahead. The average 12-month target price is $34.56, implying a 21% potential gain from current levels. Additionally, Centene's diverse operations, including Medicaid, Medicare, ACA marketplaces, and specialty care, provide broad exposure and growth options. 4. Charter Communications. Charter Communications is a broadband connectivity and cable operator. It offers internet, television, and voice services under the Spectrum brand. Similar to Comcast, Charter faces challenges from cord-cutting trends in traditional television. Its strong position in providing high-speed internet, which is an increasingly essential service, makes it a resilient business. Charter shares trade at a P/E ratio near 7.6x, far below the industry average of 17x and well under its historical average of 18.6x. Charter generates $5.2 billion in free cash flow annually, showing powerful cash generation capabilities. The low price-to-earnings ratio might reflect market skepticism about its growth prospects in a competitive environment, but its consistent cash flow from internet services could be overlooked. Analysts see good value here. Charter ranks an A value score on platforms like Zacks, highlighting its appeal to value investors. Charter is merging with Cox Communications in a $34.5 billion deal, creating a dominant player in broadband and cable services with expected $500 million in annual cost synergies. This move may further underscore Charter's long-term value potential. 5. Devon Energy Corporation. Devon Energy is an independent energy company engaged in the exploration, development, and production of oil, natural gas, and natural gas liquids. Like APA, Devon Energy's valuation is heavily influenced by energy prices. Devon maintains a dividend yield of 4.7% and operates a $3.6 billion buyback program, demonstrating strong commitment to returning value to shareholders. Its low price-to-earnings ratio suggests that the market might be underestimating its operational efficiency, its strong asset portfolio in key U.S. basins, and its commitment to returning capital to shareholders through dividends and share buybacks. 6. Conagra Brands. Conagra Brands is a packaged food company that produces and markets a variety of branded food products across retail and food service channels. Its portfolio includes well-known brands found in many households. Food companies are generally considered stable due to consistent consumer demand. A low price-to-earnings ratio for Conagra could indicate that the market is concerned about slower growth in the packaged food sector or competition from private labels. However, its strong brand recognition and ability to adapt to consumer preferences provide a defensive investment. Recent analysis estimates Conagra's stock is trading at roughly a 60% discount to its intrinsic value. The discounted cash flow model pegs the fair value at around $48, compared to the current price near $19.30. Conagra offers a high dividend yield of around 7.25%, one of the richest payouts among S&P 500 consumer staple stocks. It's maintained this dividend consistently, paying $1.40 per share annually. Trading platforms give Conagra a high value score of A, signaling strong appeal for value-conscious investors. 7. Bunge Global SA. Bunge Global SA is a leading agribusiness and food company. It operates in the areas of oilseed processing, grain origination, and sugar and bioenergy production. Bunge plays a critical role in the global food supply chain. Its valuation might be affected by commodity price volatility, global trade policies, and agricultural yields. Bunge trades at a forward PE ratio of 10.5x, substantially lower than the industry average of 16.9x, suggesting it's priced cheaply relative to competitors. Its diversified operations and essential role in food production suggest that its current valuation might not fully capture its fundamental strength and importance. 8. Edison International. Edison International is an electric utility holding company. Its primary subsidiary, Southern California Edison, provides electricity to a large service territory in Southern California. Utility companies are typically stable investments due to their regulated nature and consistent demand for their services. Edison trades at a low PE ratio of around 9.0 in 9.8x, compared to the industry average of 14 to 17x, signaling a significant discount. Edison offers a robust 6% dividend yield, with an annual payout of around $3.30 per share. Analysts see a potential till the 24-36% upside, forecasting a target price in the $69 range, based on steady regulated growth and utility fundamentals. It scored an A4 value in investment rankings and has a favorable Zacks rank, by, indicating solid value appeal and analyst confidence. 9. Molina Healthcare. Molina Healthcare is a managed care organization that provides government-sponsored healthcare programs for qualified individuals and families. Similar to Centene, Molina operates in a sector with consistent demand due to government programs. Its low price-to-earnings ratio might reflect market anxieties about healthcare reform or changes in government funding. Molina trades at a very low PE ratio of approximately 8.6x, which is 58% below its 10-year average of 20.5x. Compared to healthcare peers, Molina's PE is significantly lower than the industry average of 21x, indicating a potential discount to its sector. The average 12-month target price from analysts is around $243, which implies approximately 39% upside compared to its current trading level. Further, detailed fair value models suggest Molina might be undervalued by up to 60%, with intrinsic value estimates near $435 per share. 10. Synchrony Financial. Synchrony Financial is a consumer financial services company. It provides private label credit cards, dual-branded credit cards, and installment loans. As a lender, Synchrony's performance is sensitive to economic conditions and consumer credit health. The stock is trading at a very low P/E ratio of about 8.6x, much lower than many of its peers and in line with value investing criteria. Analysts project a 12 to 14% upside, with average price targets around $80.82, suggesting some growth potential. A low price-to-earnings ratio could also suggest market worries about potential loan defaults or rising interest rates impacting its profitability. 11. Delta Airlines. Delta Airlines is one of the major airlines in the United States. It provides passenger and cargo transportation services. The airline industry is highly cyclical and sensitive to economic downturns, fuel prices, and global events. Delta is trading at just 89x earnings, well below industry norms. Its intrinsic value appears higher. Financial models suggest the stock could be 24 to 32% undervalued compared to its calculated fair value. Despite sector challenges like tariffs and recession fears, Delta continues to outperform thanks to strong premium travel demand, diversified revenue streams, and efficient operations. Some analysts view it as one of the strongest bets in travel stocks heading into 2026. 12. General Motors Company. General Motors is a global automotive company that designs, manufactures, and sells cars, trucks, and automotive parts. The automotive industry is undergoing a significant transformation with the shift towards electric vehicles. General Motors' intrinsic value, based on a two-stage discounted cash flow model, is estimated at $81. At the current market price of around $48.56, GM is approximately 40% undervalued. GM's low price-to-earnings ratio could be a result of market concerns about the high costs of this transition, intense competition, or potential disruptions from new technologies. GM's P/E ratio is just 8.5x, far below the auto industry average of around 19.5x, a sign that the stock is priced cheaply relative to peers. However, GM's established manufacturing capabilities, global presence, and investments in electric and autonomous vehicle technology position it for future growth. 13. Eastman Chemical Company. Eastman Chemical Company is a global specialty materials company. It produces a broad range of advanced materials, chemicals, and fibers for various industries. Chemical companies can be sensitive to raw material costs and industrial demand. Eastman's low price-to-earnings ratio might indicate market concerns about economic slowdowns affecting industrial production or specific product demand. Based on a two-stage discounted cash flow model, Eastman appears to be about 40% undervalued, with fair value estimated near $127 compared to its current price around $76. The company's focus on specialty products, innovation, and diversified end markets provide resilience. 14. Arch Capital Group Limited. Arch Capital Group is a global insurance and reinsurance company. It provides property, casualty, and mortgage insurance and reinsurance products. The insurance industry is subject to underwriting cycles, catastrophic events, and interest rate fluctuations. Arch Capital trades at a P/E of about 8.6x and 9x, which is significantly lower than the insurance sector average of 14 to 14.5x. Suggesting it's priced attractively compared to similar companies. The company offers a dividend yield of around 5.3%, with an annual payout of roughly $5 per share and a healthy payout ratio near 50%, demonstrating strong cash distribution to shareholders. According to Peter Lynch's fair value formula, Arch is valued at $249, implying a potential gain of 165% compared to its current price of $93. 15. Universal Health Services. Universal Health Services is one of the largest hospital management companies in the United States. It operates acute care hospitals and behavioral health facilities. Healthcare providers face challenges such as staffing shortages, rising costs, and reimbursement pressures. UHS's low price-to-earnings ratio might be due to these operational headwinds. Chartmill gives it a valuation score of 9 out of 10, noting its forward PE of 8.5x places it cheaper than 90% of its healthcare competitors. However, the consistent demand for healthcare services and its strong presence in key markets provide a stable foundation. 16. AES Corporation. AES Corporation is a global power generation and utility company. It owns and operates a diverse portfolio of electricity generation and distribution businesses. As a utility, AES provides essential services, but it is also undergoing a transition towards cleaner energy sources. Analysts estimate AES is trading at around $13.50 per share, while its intrinsic value is approximately $28, based on a blend of discounted cash flow and relative valuation models, suggesting a potential 52% undervaluation. Its low price-to-earnings ratio could be influenced by the capital intensity of this transition, regulatory uncertainties, or commodity price exposure. However, its strategic focus on renewables and its diversified geographic footprint offer long-term growth potential. 17. Pult Group. Pult Group is one of the largest homebuilders in the United States. It designs, constructs, and sells homes. The homebuilding industry is highly cyclical and sensitive to interest rates, housing demand, and economic growth. Analysts' valuations suggest Pult Group could be up to 49% undervalued. With current share price around $132, fair value estimates stretch to $250, indicating substantial upside potential. In Q2 2025, Pult Group repurchased $300 million in stock. However, its strong balance sheet, efficient operations, and ability to adapt to market conditions make it a leading player in the sector. 18. Allstate Corporation. Allstate Corporation is a large personal lines insurer in the United States. It provides auto, home, and other insurance products. The insurance industry faces challenges from severe weather events, competitive pricing, and investment market volatility. Wall Street's average 12-month price target is about $230, implying an 11 to 12% upside from current levels. Fair value estimation is $284. Discounted cash flow models estimate fair value at around $284, suggesting the stock could be over 25% undervalued based on intrinsic worth. Its strong brand recognition, extensive agent network, and efforts to manage risk and improve profitability make it a resilient company. 19. Halliburton Company. Halliburton Company is one of the world's largest providers of products and services to the energy industry. It offers a broad range of services for oil and natural gas exploration, development, and production. Halliburton's performance is closely tied to the activity levels in the oil and gas sector. A discounted cash flow model estimates Halliburton's fair value at around $42, while the current price is approximately $23, making it nearly 47% undervalued. However, its technological leadership and global presence position it to benefit from long-term energy demand. Diamondback Energy. Diamondback Energy is an independent oil and natural gas company focused on the Permian Basin in West Texas. As an exploration and production company, its valuation is highly sensitive to commodity prices. Its low price-to-earnings ratio could indicate market skepticism about future oil prices or production growth. Analyst models using discounted cash flow suggest that Diamondback Energy is trading at a significant discount, roughly 48% below fair value, with the current price near $143 and estimated fair value around $282-287. However, Diamondback's low-cost operations, strong asset base in a premier basin, and commitment to capital efficiency make it a compelling investment within the energy sector. Investing in undervalued stocks requires careful analysis and a long-term perspective. While the companies listed above show promising signs of being undervalued based on their price-to-earnings ratios, it is crucial for investors to conduct their own thorough research into each company's financial health, industry outlook, and competitive landscape. The goal is to identify companies with strong fundamentals that are temporarily trading below their intrinsic value, offering the potential for significant returns as the market eventually recognizes their true worth. Remember that all investments carry risks, and diversification is key to managing those risks. This information is for educational purposes only and should not be considered investment advice.